Hi, and welcome to this free video course, How to Build Wealth Quickly in the Stock Market using our simple, proven three-step method. My name is Brian Neal. I'm founder of Tradetobefree.com. You're going to really like this presentation. It's going to show you a great methodology for really building wealth quickly in the market. Now, I want to talk about what's covered in this course. I'm going to be focusing on the techniques that I have personally used in my own account to achieve great results, and techniques that have quadrupled your money over the past 5 years, or would have, while the overall market went nowhere. Now, this is based on backtesting over a 5-year period between the beginning of 2007 and early 2012. And this time period included the financial crisis, where most investors lost money. And I'm going to go step by step through this methodology. I'm going to show you all the necessary actions you need to take to use it properly, to yield the results that I've yielded in the past and that were yielded in the backtesting. The new methodology is beating all the other methodologies that we've looked at, including ZAX and IBD, the ZAX ranking model, and also the IBD Top 100, and virtually every other methodology out there. Every methodology that I've looked at, and I'm going to show you how you can do this too while spending just minutes per week. And more importantly, or just as important, I'm going to show you why this works and why it should in the future. The underlying reasons for this are very, very important, and you can use this insight in your own trading or investing regardless of which methodology you use. This course is going to be delivered to you in 3 steps in several emails over the next few weeks. Afterwards, I'll be sending you some investing and trading tips from time to time to improve your results even more. A lot of great information I have in store for you, so you want to check your inbox for the latest tip and instruction, and you're going to learn a lot. Okay, I just wanted to take a step back here first and go over stocks and what they're worth and why stocks go higher, and my philosophy, my theory behind this. And stock price to me is based on the current and future expected earnings and cash flow generation power of the company. How much money can this company make? A company who's publicly traded can be bought out at any time, and usually it's at a premium, and that's because companies have the ability to earn a return. They have an earnings yield, and that earnings yield can be very strong and can grow over time. Okay, so if a company is expected to grow their earnings and sales over time, their valuation will be higher because of that expectation, and that value is born out of the open market, the free market, where buyers and sellers actively trade and invest. Now, the real valuation and the reason why stocks go up is not quite that simple. There's more factors involved. For instance, a lot of it has to do with institutional investors and what the trends are in that marketplace. If supply and demand factors, so if a particular industry is in favor and people are desiring to find funds that invest fairly heavily in certain industries, those fund managers are going to buy those stocks, and if those stocks are in short supply in that industry, those stocks will tend to go higher, much higher, regardless of how much those companies can earn at the present or in the future. So it's not quite that simple. It also depends on the overall mood of the market at the time, and so forth. But the primary factors are the expected and the present earnings and cash flow generation power of the company. Now, why would the stock price increase then? Well, because the earnings and sales grow. So if the company all of a sudden is earning more money, or the sales are growing, that would lead to higher prices in the stock. Usually you want to have both move in the same direction at the same rate. Otherwise, there could be a margin issue, and that can actually hurt the price of the stock. But by and large, if the earnings and sales grow over time, the value of the company will grow. And another reason why the stock price increases is because the management is proving themselves to be able to grow the sales and earnings, or the business model is being proven with that growth of sales and earnings over time consistently. So if they can grow sales and earnings for, that's great, But if they can do that for years, then the business model and the management's proving themselves that they can do that continually and consistently, and that will lead to higher prices. And another price would increase is because the future expectations for the company are increasing. So analysts and the company themselves are looking at a brighter future for some reason. Maybe they've bought another business, maybe they've found a new or discovered a new product and are releasing a new product soon. Maybe they're seeing stronger sales and earnings than they thought. Whatever the reason, the future outlook is looking much better. And if companies can actually meet those expectations or beat those expectations consistently, then the market will value that increase in expectations more favorably for the company and stockholders. So UPOD is key. So we want to see companies under promise and over deliver if possible to prove. So when the estimates do increase and the outlook does get better, investors can look at the past and say, well, this company has done in the past where they've beaten these estimates or met these expectations well in the past. So we're going to lend more credence to the future expectations increasing. So under promising and over delivering is a key factor to determine the stock price and whether it increases. If we look at all the biggest winners in market history, there's one common theme amongst all these companies. The Apples of the world, the Microsofts, Home Depot, Walmart, Cisco Systems, and most every big market winner in history, and that is that they grew their sales and earnings quickly over time, and they did so very consistently. So there's an underlying theme that's very, very strong, and oftentimes these companies have products and services that are changing their industry or even changing the way we live. And in most cases, they're also beating their estimates consistently, and their estimates are trending higher. So usually these companies have momentum that grows over time, and that's reflected in the fact that they beat their estimates consistently, and their outlooks improve over time. Okay, so let's look at why most investors fail then. I mean, if the only secret was to find companies that are growing their sales and earnings consistently over time, we could just do that, find those companies and just buy those companies. Many companies can grow their earnings and sales strongly in the short term, but they could miss expectations and fail to grow quickly over the long term. And this is what we see most commonly. And when they do this, when they fall short, is when the stock really gets hit. Now, for a top growth stock like Apple and Microsoft and Cisco, eventually what will happen is they'll hit a point, even though they are growing their sales and earnings very consistently over time, there'll be a point where they just can't grow as quickly anymore. And so their valuation goes from a growth stock valuation, which is higher based on the expected future growth, to a value stock valuation, which is much, much lower. So typically what we see is with top growth stocks, we see at some point the growth phase end for a stock and the stock price actually come down on an average of 70% once this growth phase is over. And this is actually the average haircut, and it's very normal in the stock market. We see that all the time, and typically you see this growth phase during a bull market, and then you see the phase where it contracts, the price contracts down to a more value stock valuation during a bear market. So the trick is to find those stocks that are growing consistently, that will continue to grow consistently over time. And there's no way to guarantee that we'll find that you'll spot that. And that's the trick with investing. I mean, that's the danger of investing, is when is a party over? When is the growth phase over for a stock? It could be at any time. It's difficult to know exactly when. So what can we do about it? How can we avoid these situations, buy these great stocks when they're growing, and get out and not be in them when the growth phase is over? Well, one way we can do this is we can buy stocks that are consistently growing their sales and earnings and whose estimates are trending higher now, not only in the past, but currently. And once this growth eases a bit and certain other factors emerge, we need to get out and sell before the stock starts to fall apart. And right before the top in a stock, there's often certain technical events that occur, certain chart patterns that emerge, and other key things that we look for in a stock chart to indicate that the growth phase is over and the stock is about to correct in a big way. So what we need to do is we need to keep a list of stocks whose estimates are rising and who are growing consistently strong enough. And then when you want to sell these stocks, when another stock comes along with better factors, with better growth, with more consistent growth, and with estimates that are trending higher. And this first step, of course, in this process, in using this methodology, is to find the stocks that are growing quick enough, consistently enough, and whose estimates are rising. And there's several screeners out there that can help you do this. A couple of them are Zacks and finviz.com. And you just need to go back on some of these screeners. You need to go back and check, say, Yahoo Finance or the annual reports to see if the growth has been consistent. Because usually with these screeners, you can find the current growth, the growth this year, maybe next year, the expected growth. But to find historical growth, sometimes is more difficult. And usually you can find an average growth, but we want to find those companies that are growing consistently throughout the years. And to do that, we can sometimes go back to like Yahoo Finance or and look at their synopsis of the SEC filings. And I believe there's a link for cash flow and income statements and balance sheets, and they'll summarize those for you on Yahoo Finance over the past 3 years, and you can see if the growth has been consistent over those years. Another way you can build a list of these stocks is by checking sites that have updates of major news items for each of these stocks, like briefing.com, which will give you an alert if companies' guidance is raised, if an analyst comes out and raises their guidance for this year or next, if they beat estimates on the earnings report by a wide margin, and so forth. So there's a lot of companies, companies that keep track of this, and a lot of sites out there you can go to. CNBC is another one you can go to get a list of stocks with the biggest earnings beats over the past several weeks during earnings season. So you can check that out too. And we also provide this service on Tradetobefree.com. So we make this list, very comprehensive list, and what we'll do is we'll take that list and we'll weed it down to the top 3 stocks each week, and these 3 stocks we feel are most likely to go higher the following week. So that's a great service that we offer, and you can check that out on our site. So that's basically step 1. Find those companies with the consistent earnings and sales growth, whose outlook is improving. And step 2 in this process of using this methodology is coming up next over here in the next few days. That's a free lesson again. So in that lesson, I'm going to show you how I weed out the losers from your list before you start putting your money to work using technical analysis. And that'll be a very, very interesting topic, and it's a very key topic to cover before you start putting money to work, because we don't want to go into those stocks who are showing signs of topping and are going to come back down to earth, so to speak, after the growth phase is over. So if you have any questions on anything, if you need any more help, just shoot me an email at info@investtobefree.com. I'd be happy to answer any questions you have. And again, look forward to seeing you again here in the next few days with our next lesson.